Hello everyone, my name is Gabriele Foà and I am a portfolio manager for global credit strategies at Algebris. I'm here today to give you an update regarding the ongoing Iran situation, the resulting market volatility and our positioning in global credit funds. As we know, since roughly a week, a new war is hitting the world. On one side, US and Israel, on the other one, Iran. Initially, the conflict seemed to be a short one, with markets basically trying to shrug off the long-term consequences. The big variable for markets is conflict duration. The Gulf area represents roughly 20% of global supply, so a disruption to transit via Hormuz or physical disruption of Gulf refineries can be very costly for the world. If the conflict lasts for 1 week or 10 days, then no physical disruption happens, so oil prices stay up for a short amount of time, then they go down and no disruption happens, so the markets basically can happily go back to the highs. But what happens if we have a longer conflict? If we have a longer conflict, oil markets will immediately go into physical destruction, so physical deficit, so demand will be much bigger than supply, and at that point we will have serious macroeconomic consequences, lower output and higher inflation. So for markets, we have a very binary situation. Short duration, basically we go back status quo, and long duration, we should price some stagflation. In general, markets have a lot of downside in our view, because the move we had so far was very quick, but was still relatively limited. When you look at over the past 10 days, we had a 6-7% move in stock prices. We have a 30-40 basis point widening in credit, and we have a large but not extreme move in VIX, so in implied volatility. So if we have further disruption in markets, definitely there is some more downside for risky assets. One important point to make is markets are being hit by this shock at a very fragile time. In the past 2 years, broad markets saw generalized rally, and positioning of investors across markets is very long for every asset class. So, looking at this episode, it's true that geopolitical crises often end up being an opportunity, but here, in our view, we are relatively at the beginning. The volatility just started, the market is long, and we still need to go through the cycle of a potential crisis before seeing an opportunity in risk. Another important point is the reaction of duration. Risk is suffering, and that makes sense, but interest rates are widening, and that's less obvious. When you have a stagflationary shock, you tend to have lower output and higher inflation, so there is a dilemma for central banks. They may cut or they may hike. Market, in the current environment, is assuming they will hike. If you look globally, markets now price hikes everywhere except in the US, and this is probably because market is fresh of the experience of 2022, when we had a commodity shock and all central banks decided to hikes, even if credit markets and equity markets briefly priced a recession. We think this situation is a bit different, and the reason is that in 2022, central banks were very behind the curve to begin with. Just to give you a sense, when the ECB did the first hike, inflation was running at 9% and interest rates were negative. So central banks were very much behind, and now they are in a very different spot. When you look at historical experience, 2011, 2008, but even in the 90s and in the 80s, the reaction to a commodity shock is not obvious, and when the data show that growth is actually negative, central banks tend to hold or cut, and so to privilege growth over inflation. That means it may be early to fade any of these. As I was saying at the beginning, the market is in a very initial phase of the shock, but the direction of travel of duration seems a bit off, and the duration and interest rates, especially in core markets, may be the first place where to fade the shock whenever the opportunity arises.